Okay, so we're going to continue our conversation about stocks and other forms of investments. So as far as watching your stock markets and watching your individual stocks, you have your two stock exchanges. You have your New York Stock Exchange, which is our largest organized exchange in the United States. They have over 3,000 stocks or companies that are traded on the New York Stock Exchange. And these are publicly traded stocks that anyone can purchase through a stockbroker or an online brokerage firm. NASDAQ is the largest technology exchange in the United States. The NASDAQ has more trading volume in any day than any other stock exchange in the world, meaning it has fewer companies represented on the NASDAQ, but there's more purchasing and selling on the NASDAQ than there is on the New York Stock Exchange on any given day. And the NASDAQ is typically known for more technology-based companies, so like Microsoft, Apple, Intel are traded on the NASDAQ versus non-technology stocks. There are technology stocks on the New York Stock Exchange, but just not nearly as many as the NASDAQ. So indexes are a benchmark that investors use to judge the performance of their own investments. So instead of looking up each individual company that you have stocks invested in, you can use these index to get an idea of how your overall stocks will be doing. So three of the biggest ones are our Dow Jones Industrial, which is an average of the price movements of 30 major stocks listed on the New York Stock Exchange. Companies you're familiar with would be Disney, Coca-Cola, and Procter & Gamble. NASDAQ composite average stocks from some of the most volatile high-tech companies. So Microsoft, Intel would be represented on their composite. And then you have the Standard & Poor's 500, or also known as the S&P 500, and that's the second most widely followed index behind the Dow Jones. And that consists of companies traded on both the New York Stock Exchange and the NASDAQ. And I can show you, and there's, once again, great resources to use out there, but this is Google Finance, and Google Finance can show you how these indexes have done over time. And you can see the dips. We're going to show that there's been some negative changes in stock values. Now this is just done for the individual day. If we took a look at the last 5 years, or let's even take a look at the last 10 years, you can see how the stock market has done since our recession. So I'm going to move down here so you can see that as of 2010 we were definitely below our original benchmarks, and you can keep moving down and see how our stocks have done during that time. So you can see our huge downturn during the recession, which was pretty significant. And we continue to work through. So it's been a very tumultuous last 10 years on the in the stock markets and being a stock investor. Other investments that you can invest in are mutual funds, and I like to look at this pie chart here to take a look at kind of exemplifying what a mutual fund is. And these are professionally managed portfolios made of stocks, bonds, and other types of investments. Individuals buy shares, and funds are used from money to purchase stocks, bonds, and other investments. Profits are returned to shareholders monthly, quarterly, or semi-annually in the form of dividends. The advantages of a mutual fund is allow small investors to take advantage of the professional account management and diversification normally only available to large investors. So what I like to consider about mutual funds, if you look at this particular technology mutual fund, you see Microsoft, Intel, Apple, and IBM represented on there. If you owned that technology mutual fund, you would now be invested in all four of those firms, and more heavily in Microsoft than maybe IBM. But the nice part is that individually you may not be able to afford those stocks by themselves, but through a mutual fund and a lowered value price, you can afford that mutual fund and now be invested in four of those companies. So these are just some examples of mutual funds that are available for investors. So you can think balance, meaning you have some high risk and some low risk with some bonds in there. You have global, so you're looking at international companies. You've got companies that are represented just as growth stocks. You have dividend-driven stocks through companies that just do dividends for its investors. You can do by industry, like I just said, technology. You could do just through municipal bond funds. So there's tons of different types of investments, high risk to medium risk to low risk in the mutual fund category. Retirement plans are another long-term investment that you should consider. These are plans that help individuals set aside money to be used after they retire. Federal income tax is not immediately due on the money, but put into a retirement account on the interest that it makes. So the employer or the individual can have those funds taken out of their gross pay, directly put into a retirement plan, which then reduces their taxable income. So it reduces their amount of tax in which they have to pay currently, and then they're going to withdraw those funds when they retire, and typically their income category would be much lower, so their tax responsibility would even be lower when they retired. So penalty charges apply if money is withdrawn before retirement age, which is 65 right now, and they also offer bonuses if you pull out when you're 67 and 70 to gain more return on your investment. And then incomes after retirement are usually lower, so your tax rate would be lower when you withdraw those funds. Different types of retirement accounts are the IRA, which is an individual retirement account. A Roth IRA is a IRA in which they take the funds after they've out of your net pay, so you've already paid taxes on those. So when you withdraw those funds, you can use those monies without having to pay any additional taxes. In addition, you can pull out some of those funds for educational expenses or your first home purchase without having any tax penalty. A 401k is a retirement account set up through your employer, and your employer may match some of the funds that you invest into the 401k. And then a Keogh plan is a retirement account for entrepreneurs or those that are self-employed. Real estate is another form of investing. Types of investing that you can do is purchasing residential, land, or commercial properties. You could buy a house, live in it, and sell it later as at a profit, receiving the capital gain. You could buy income property such as an apartment house or a commercial building and rent it out and receive income, rental income, or buy land and hold it until it rises in value. The advantage of this is it's an excellent protection against inflation. The disadvantages is it can be difficult to convert into cash, and also a specialized type of investment requiring study of knowledge of the business and your communities in which you're buying this investment in. Capital gains are profits from the sale of a capital asset such as stocks, bonds, or real estate. These profits are tax deferred. You do not have to pay the tax on these profits until the asset is actually sold. Long-term capital gains occur on investments held more than 12 months. Short-term capital gains on investments are held less than 12 months. And then last but not least, we have our high-risk, high-return investments. And these are going to be examples of futures. And these are purchases or sales of assets such as oil, corn, or stock at a predetermined future date and price. Penny stocks are stocks that are traded for less than $5 per share. And then collectibles are an item that is worth far more than it appears because it has a rarity and or a demand, and common categories of collectibles include antiques, toys, coins, comic books, and stamps. So I feel like we've definitely addressed a wide variety of investments and how you can be a good investor slowly but surely, and be a good educated mindset in making smart investments for your long-term and short-term goals.